The Stock Market Trading Video Course, Part 2. Day trading versus swing trading versus long-term buy and hold. What type of trader are you? Are you a day trader, a swing trader, or a long-term buy and hold trader? We're going to go over each and every one of these and explain the difference between them. So, the time frame for a day trader is where you will hold the stock for anywhere from seconds to minutes to hours, okay? And you're usually flat by the end of the day. You do not carry trades overnight when you're a day trader. You're looking for an intraday trading move based on technical analysis, and you're flat by the end of the day. A swing trader, okay, time frame is anywhere from 1 day to a couple days, a couple weeks, all the way up to a couple months. Okay, you're looking for bigger moves and place trades based on technical analysis and fundamentals. And then there's the long-term buy and hold trader. Your time frames are months, years, all the way out as long as to decades. You're looking for big moves and place trades based on technical analysis, but mainly on the fundamentals. Okay, so usually you're going to use fundamental or a technical analysis. If you're in it for a few months, kind of look at which way the trend is. But if you're looking for years all the way out to decades, you're definitely going to be looking at technical or the fundamental side of it. If you're a day trader, who cares about the fundamentals? All you're looking for is you're looking for the intraday moves, kind of like what the algorithms, okay, the real short term, the computer trading, those are all real short term trading where they're looking for swing highs, swing lows, intraday, and they're buying and selling all day long. The swing trader, hey, maybe you like a stock for the next couple weeks, maybe Apple has earnings coming up in the next month and you want to buy ahead of the earnings. That's when you would actually buy. Okay, that's one way. Or maybe you like XYZ stock because it's sold off just over the last couple weeks, couple months, and we're at a support level. Okay, the technical analysis side, you're like, hey, I want to buy it for the bounce. So you step in, you buy your shares, and then you sell them in a couple days, couple weeks, couple months. And then there's the long-term buy and hold. So those are the three major different types of traders that there are. You, being a brand new trader or even a seasoned trader and you're watching this, try and figure out what type of trader best suits you. There are people who don't like to hold trades overnight. They're scared of, hey, what if this happens? What if the CEO dies? What happens if they come out with accounting fraud, right? You own 100 shares of a $50 stock. All of a sudden, the CEO has a heart attack overnight and the shares open up $10 lower. Well, guess what? Your $5,000 investment's now worth $4,000. So some people don't like that. So that's why they stick with a day trading. Maybe you're a swing trader. You work a second job, okay, or a full-time job. You don't have time to watch the markets all day, every day. Okay, so maybe you just buy stocks and, hey, I like GoPro. I love the cameras. You buy and you hope it goes up over the next couple weeks, couple months. And then, again, the long-term, maybe you're a long-term trader where, hey, I work full-time. I just put the stock away and I'll look at it in 20 years when I retire. So those are the different types of traders, and you need to figure out what type of trader you are. Supply and demand. Supply and demand is equivalent to buyers and sellers, right? So supply and demand is, think of it this way. Every stock has so many shares that are available. Okay, so we'll say Microsoft, okay, has 1 billion shares. Okay, that's how many shares are outstanding. Well, if the company's worth $50 a share, okay, and there's 1 billion shares, then the market cap is $50 billion, right? Now, what happens is somebody might come in and buy 100 million shares. Well, guess what? There's now only 900 million shares left for the public, right? They're outstanding. So those 100 million, there's actually less supply and more demand. Now, if somebody comes out and sells 100 million shares one day, okay, and then what's going to happen is now there's more demand than supply. And when there's more supply, okay, available, the price will go lower. When there's more demand, the price will move higher. And that's where the buyers and sellers, right? More demand means there's more buyers in the market. When there's more supply, there's more sellers who are selling their stock. Buying long stock, okay? Well, if you buy long stock, what you're doing is you're buying the stock, you hope it moves higher, and then you turn around and sell it. Very simple. Selling short stock, this gets a little more tricky. What essentially is happening is you're betting actually for the market to move lower. Maybe you don't like management. Maybe you don't like what their product. You don't like the fundamentals side of it or the technical, and you want to bet for the stock to go lower. Okay. Well, what happens is you're going to go to the marketplace and you're actually going to sell shares. Now, what's happening in the back, okay, electronically, and it happens all within a couple milliseconds, is they're borrowing shares from somebody else, okay? So if I'm long stock in my account, let's say I have 10,000 shares of Apple that I'm long. Well, if you want to short those shares, because it's illegal to short sell naked, right, without anything out there, what's going to happen is they're going to go look at everybody in the clearing firm, okay, or the brokerage firm, and they're going to say, who actually owns these shares? Oh, look, Jason owns these shares. Okay, you want to short 1,000 shares of Apple. They're going to come over, they're going to take 1,000 of my shares without me knowing it, and they're going to sell them to the market. Okay, now I'm still essentially long 10,000 shares of stock, but what it's doing is I'm realistically only long 9,000 shares, because what you did was you took and you're borrowing 1,000 of my shares and you're selling it to the marketplace. Now, if the stock goes lower, you make money. If it goes higher, you lose money. Okay, and what's going to happen is your account's either going to go up or down, and mine's going to do the complete opposite on those 1,000 shares. It's either going to go up or down, okay, because if the price of the stock goes lower, you're making money. Let's say we take the 1,000 shares, it drops $1, okay, you will have made $1,000. Well, my account, because I'm long, right, 10,000 shares, but on those 1,000 shares, I'm going to lose that $1,000. Now, when you're ready to cover the stock, okay, and close out your position, what you're essentially doing is you're going back into the marketplace and you're going to buy those 1,000 shares. So the stock has dropped $1. You buy back 1,000 shares to put those shares back into my account, and you're going to make that $1,000 while I have lost $1,000. Now, on the flip side, if the stock goes and you're short the 1,000 and the stock moves higher by $1, okay, you've actually lost $1, correct? So what happens is you buy those back for $1 higher, you actually have to go with $1,000 of your cash is going to get transferred to my account, right? Because I'm missing out on that $1,000 because you actually sold my shares. So you're just kind of doing an IOU and you're paying me when you close out the position the same $1,000 I would have made. So I hope that kind of makes it in the simplest form what selling short stock is. All you're doing is you're betting for the stock market to go, or sorry, that stock to move lower. When you're buying stock, you're betting it for it to move higher. Okay. Now, when I buy stock, I buy it. When I'm ready to sell it, I sell it back to the marketplace. Now, what happens is kind of going back to the supply and demand side. When I buy the stock, okay, what's happening is I'm taking supply off the market, right? If I sell the stock, what I'm doing is I'm actually taking supply off, okay? So that's something to really think about as of what short squeeze is. Like if too many people are shorting the stock, they're borrowing everybody's long shares, okay? Eventually, good news comes on the company, they're all going to have to sell their stock, right? Or cover their position because it's going against them. And what happens is they're essentially going into the marketplace, buying back all the stock, and now it's creating a demand for price to move higher. So that's what selling short stock is. Now, market makers. What is a market maker? Okay, a market maker is somebody who actually makes a market when there's no buyers or sellers. They're always having to show a bid or ask. So if there's not a market, if there's no buyers for the next $5 lower, they actually have to make a market for all those buyers, okay? So if somebody wants to, or sorry, for the seller, so if somebody wants to sell their shares, the market maker has to step in and actually buy those shares from them. Even though they don't want to buy them, they have to. Okay, but then what they'll do is they'll turn around and just sell those shares to the next buyer that wants to come in at a higher price. And they're just maintaining an orderly market. That's what a market maker does. HFT, okay, high frequency trading, also known as algos in computer trading, okay. What these are is these are the computers that are buying and selling all day long. It's computer trading. You have about 70% to 80% of all trading nowadays are done through algorithms. They're just buying and selling all day long, okay. Let's say you're a hedge fund, or there's a hedge fund that they want to start to accumulate a position. What they might do is create an algorithm that says, I want to buy 1,000 shares of stock every 3 minutes at whatever price. Okay, they can't go in and buy 10, 20, 30, 40 million dollars worth of stock all at one time. There's not enough people to sell them that stock, right? So for every buyer, there's got to be a seller, right? So what they'll do is they'll just buy all day long for the next couple weeks, every 3 or 4 minutes. And that's what algorithms are doing. And what they're essentially doing is they're building a big position, okay? And then institutional trading, also known as big money, the pensions, the hedge funds, okay? These are the big guys who are buying 50,000 blocks, right? Sometimes they're like, okay, hey, just give me this many at this price. They don't care what they pay. And you might see a big spike in the stock, right? It might rally maybe 30 cents on just one big order because they're just buying at any price they have to get in, okay? But remember, they're just buying at all these different prices. So that's what the big money, pension, and hedge funds are. Coming up next is going to be part 3 of the stock market trading course.